Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Jared Blikre, your host, and with me is Yahoo Finance's Brooke DiPalma, who's here to keep the discussion moving without too much wonkiness. And today we're going to be digging into exchange-traded funds, or ETFs, some of which are now looking more like hedge funds, while others are just adding leverage to stocks like Nvidia and Tesla, which brings us to the phrase of the day, leverage ETF. Their popularity has exploded recently with new funds coming every single month, and leverage might add some juice, but how best to manage that risk? This episode is brought to you by the number 1.18%. That is the real yield on U.S. 10-year treasuries, which have fallen to a 2-year low, how inflation hurts savers, and what this means as investors await the next Fed rate cut. And today we are welcoming Will Rhind. He is the founder and CEO of GraniteShares, which manages a suite of ETFs, including some that hold commodities, others that trade options, and yet others that add leverage, which I was just talking about. So Will, managing all these ETFs, I got to think that you have kind of a bird's eye view into some of the things that are hot with investors. Just tell us how you're seeing the market right now through that lens.
Yeah, I think really the two hottest themes remain. And those are, on the macro side, it's AI and cryptocurrencies. And then in terms of how to express that, it's a combination of leverage and options-based income. I think the major areas of the market.
Perfect. So let's get right into our phrase of the day, which is leverage ETF. A leverage exchange-traded fund uses derivatives or debt to magnify the daily gains and losses of a stock or index by 2x or 3x, increasing both potential rewards and also risks. So one of the key words in there is daily, and we can get to how these things work in a second, but tell us about the demand for these leverage products, because I keep seeing the flows go up and up and up to the right.
Yeah.
So the demand has been huge. This is really a category that was started 3 years ago, and it seems like it's grown massively since then. And in essence, it's democratizing, access to leverage that previously was only available through brokerage account or your stockbroker. Now you can buy an ETF which has embedded leverage and exposure to your favorite stocks, be it Tesla, Nvidia, et cetera. So it's exploded in popularity.
And I guess I'm just curious, what are some risks or potential upsides that investors need to know about when looking at potentially investing here?
Yeah, it's a classic risk reward, isn't it? There's no reward in life without taking risk. And so if you're saying to people that they can achieve 2 times the daily return of Nvidia, for example, then by definition, there has to be risk attached with that. And it's that, well, if it goes down, then you get 2 times the loss as well. So that's the pro and the con, but they're for people that clearly have very high conviction on stocks, be on the long side or the short side.
And so no reward without some risk here.
Yeah, and I just wanted to highlight, I kind of emphasized the word daily before. So we're talking about magnifying the daily returns. And the reason I talk about this is I like to give the example that sometimes if you have the underlying stock, let's say it's Nvidia and it's going like this, but it's very volatile, the underlying leverage product can actually lose money. So Nvidia could be net up, but if it's doing it in a very volatile day-to-day fashion, the levered product could lose money. So how does an investor balance this risk? Are these products for longer term investors or just some of the shorter term ones?
Well, they're definitely more for shorter term, that's for sure. I think that there's really a trade-off in terms of how they're built. So if you think about traditional leverage investing through a brokerage account, well, what are the pros? Well, the pro is you get the leverage. The con is the cost, and also the fact that you're subject to margin calls. In other words, if the trade goes against you, you might have to put more capital to work.
Always at the worst time, too.
Exactly. And so a lot of investors lose money, not because they were necessarily wrong directionally, but because the timing was wrong and therefore they got stopped out through margin. What leverage ETFs do is remove that margin problem. So the margin is embedded in the product, but in order to achieve that, you have to rebalance the portfolio at the end of each day. So that means you get constant leverage, which means that if it's 2 times leveraged, doesn't matter whether you buy today, whether you buy 6 months from now or 6 years from now, you will get 2 times the daily return of that stock. whatever it may be. But over time, when it rebalances, you don't get the linear 2 times return of the underlying stock.
So now if it's up over a month, that's not really relevant to the discussion here because it's daily returns that are magnified.
That's right. It will be plus or minus at the end of that month, but not necessarily exact same.
How do you assess where exactly to go? Are you looking at the holdings within the ETFs? Are you looking at this daily leveraged return?
I think we look at it as like tools in the toolkit. So these are very precise ways to gain leverage if it's long or short, leverage short if you're bearish on particular stocks. So it's for somebody who has a very high conviction view on a given stock, whether it be positive view or a negative view, and these products just express that. Now, in terms of how we create it, we're always trying to match that demand to the supply. And so right now, the big trends are tech, particularly with AI, with crypto, and we're trying to marry that demand from investors with the right products and new products to bring to market.
I want to ask you about the option strategy that some of your products employ here, some of the ETFs. This reminds me of smart beta products that came out, I think it was 20 years ago, in the very first ones. And these are just hedge fund strategies that an ETF mimics. And one of these strategies could be selling options so that you get that premium income. Tell us how these work and how you decided on this one particular strategy for your funds.
Yeah, so I think this is a great expression of like the value of ETFs sometimes, is that ETFs take something that exists already, but they package it into a much more accessible form. So selling options on a stock or an underlying asset is not a new thing, but it's something that not everybody has access to, not everybody wants to do, not everybody...
Can be very risky too.
Can be risky. So by packaging it into an ETF, you create a single ticker solution whereby somebody can buy an ETF and get exposure to whatever the underlying is with income. And the reason why that's attractive at the moment is because selling options, you're effectively selling volatility. Volatility can be very high right now, depending on the underlying asset. And therefore you can generate yields that would be probably far outside of people's expectations. And Yield Boost, which is the offering from GraniteShares, what we do is we marry the selling options part with leveraged ETFs. And the reason for doing that is you generate, say, 2 times the expected notional income that you would get by selling an option on a stock. So if you take the highest one we have at the moment is COYY, which is a Coinbase underlying linked leveraged ETF.
Crypto.
Yep.
Sure.
Yeah, there we go. So annualized yield is about 180%. So that is right at the top of the range. And then you have things that are around 100% for, say, like Bitcoin, or close to 100, 120%, 150% for some of the stocks. So these are very, very outsized yields that people are getting exposure to from these option strategies.
Walk us back a bit, though, for a second, because if we've seen crypto, we've seen Coinbase see just such high returns, then why would it benefit investors to maybe go to something else besides the actual stock itself?
It's a great point. So I think it comes back to the tools in the toolkit. And what I've seen is that once upon a time, you used to go to a mutual fund company and you used to buy a fairly generic mutual fund strategy that promised to give you growth and income.
Right.
The reality was it gave you not much growth and not much income. And we've seen the ETF market really replace that by taking those 2 components and saying, hey, if you want growth, we can give you really good growth, or we can give you hyper growth if it's leveraged. Or if we want income, we can give you all sorts of flavors of income, including some very, very high income. So the market is kind of bifurcated in that way, whereby people, I think, are going more to specialist interpretations, and therefore you ended up building a portfolio, which if you're building for growth, then that's not the income products or the options-based income. If it's for income, then you're looking for these kind of investments that generate, really high income.
Yeah.
So far, we've touched on leverage. We've touched on volatility. We just hit crypto a little bit. And so I'm wondering, because where I'm going is I notice that these products come out in cycles and they tend to kind of mimic whatever is hot at the moment. So I'm thinking a little bit farther in the future. What do you see coming out that in terms of new products that might speak as to the future market environment here? Any signals to be gleaned there? I'm looking for alpha.
Well, I think that you've maybe seen a little bit of it in the last sort of couple of weeks that, some of the so-called value stocks have started to have a bit of a resurgence. Commodities is an area that's been, really hit hard with the exception of gold and some of the precious metals that have caught the eye of some in the trade war. So I think if you're looking at, things that are potentially could bounce back or benefit over the next few years, those might be some areas. But, the tech stocks, and particularly the largest tech stocks, just continue to deliver the earnings, the positive earnings, which keeps them driving forward.
Absolutely. Yeah, we've seen such return when it comes to earnings. Many have beat expectations, and when they do, the markets continue to reward them, I guess you could say, with upwards of, say, a 5+% reaction the following day. I guess in your regard, just quickly, how much an investor is be keeping an eye on this, and is it too late to perhaps jump in now?
I guess there's really always
age-old question.
Right?
Is it too late?
Yeah, I think it always, first and foremost depends on the time frame.
Yeah.
Because I'd like to think that most things will go up over a certain period of time. It's just a question
Markets
of what
always
that
go up, Sam. We're like
exactly. What's the time frame you're looking at? Because clearly you could buy now, and we could go into a correction, and that correction could last for a period of time. But we are in an economy whereby companies grow, the economy's growing. And with that, you would expect the market to grow over time. And then, Jared, you briefly mentioned it, but just the impact of inflation alone means that on a nominal basis, things will be priced higher tomorrow than they are today.
And I'm glad you mentioned that because we're going to talk about that after this very short break. Coming up, we will be talking about that inflation trade and also bonds, and then a runway showdown pitting soccer strategy against Formula One. Stay tuned. This episode is brought to you by the number 1.18%. That's the real yield on the U.S. 10-year Treasury note. Here's a quick definition of the real yield. It's the regular rate of interest paid by the bond or note in this case, minus the rate of inflation, which you can get from different sources. And so we're using a model here from the Cleveland Federal Reserve. The details can get very wonky, but what's important to know is that this real yield is the lowest that it's been in a couple of years. And I should say, too, it also went negative for a brief period of time, maybe a year in the early pandemic. And so this kind of opens the discussion as to the commodities and the gold trade we were just talking about. But talk to us about real yields kind of on the decline here.
Yeah, I think this is really the major message that certainly the president or the administration is trying to hammer home, which is inflation's coming down. It's setting the table for further reductions in interest rates. And this is the sort of bullish setup for those that feel this way in the market for the back half of this year, that we're in an environment where the Jackson Hole meeting's about to kick off. While there are not sort of super high expectations in terms of rate cuts, there are expectations that rates will continue to decline, and that sets a good positive backdrop for stocks for the rest of the year.
Yeah, the likelihood that markets are pricing in is like an 80 to 90% chance that we will see that basis cut in September, but we're hoping for some tea leaves, maybe some sort of hint.
Yeah, Jackson Hole is kind of like, here's what might happen. We're going to float a new idea or justify something we've already done. Any expectations for Jackson Hole this week?
Honestly, not that much.
Yeah.
And I really...
That's what I've heard.
Yeah, and markets are really reacting that way.
I don't think so. And like you said, the market's pretty much flat. It's really all about what happens between now and the end of the year, and then even looking out beyond that, potentially new, Fed chair coming in, and therefore new policy expectations.
One thing that tends to happen when real rates come down or real yields come down, especially as they approach zero, is gold becomes a better option because, when you have higher interest rates, you got to compete against that. Gold does not pay a rate of interest. But if bonds are paying in real terms 0%, well, then gold looks a lot more attractive. Talk to about some of the gold ETFs you have. I know you have BAR, which is BAR, and some of the flows that we've seen in that recently.
Gold has been a standout investment, as everybody knows, and it sort of runs counter-cyclical to some of the other things that we're talking about, namely tech stocks, crypto, etc. And I think the story with gold is a little bit different. And what's going on really with gold is it's become the de facto alternative to the US dollar. And so this is something
Not
that...
Bitcoin.
Cool. Yeah, exactly. Yeah, central banks around the world continue to buy gold. They still continue to accumulate gold. And I think when you look outside of the US dollar, which is obviously so important globally, the gold has really become that next asset to own. And one of the things that's driving gold outside of that is this buildup of debt around the world that's been accumulated by governments. And there's really no serious conversation arguably being had anywhere in the world about reducing government debt longer term. So deficit conversations, something different, but again, that was big in terms of driving gold prices. So I think longer term, this is about something that is an alternative to paper currencies, a hedge against government debt, and therefore it will continue to be popular.
What else are you putting gold against the US dollars? What are investors' other ways they're looking to hedge against? Or
Internationally, currencies, anything in there.
Exactly. And I think one of the things was or is treasuries. And treasuries,
The bonds themselves.
Bonds themselves, and had a huge amount of cash, sitting on the sidelines, and treasuries and money market funds. And as you talk about, Jared, that with real interest rates coming down, that 5% that you were earning just sitting in treasuries.
It always takes a while, though. It takes a year, but eventually people figure out, I'm not getting that 5%. Time to move that cash somewhere else. Where are they going to put it? I want to ask you, do you have any other products in the lineup, or I know there's probably SEC rules that would prohibit you from discussing specifics, but where do you see opportunities in the ETF space that are not being addressed right now?
I think, look, for us, it's really trying to continue the trends that are really important or really popular at the moment. And so that's leveraged ETFs on one hand, that's high yielding, options-based income ETFs on the other. There are definitely more things to be done, I think, in the options world, and that's something that we'll be looking very closely at. And then I think it's also trying to invest or answer investors' needs with different thematic exposures that become relevant, as policy changes, as market conditions change, or the environment changes, and just trying to be sensitive to those.
Could I ask you what you like right now in terms of investment? It could be sectors, it could be stocks, broad investment themes. What do you think has the best shot right now?
I still think it's the same thing that has really been number one for the last 2 years. That's AI. So AI,
NVIDIA out next week.
Yeah, AI is the investment theme. It's the fourth industrial revolution. It's the thing that is taking over everything. That, to me, is the most important investment theme. NVIDIA is the most important stock in that. And that's the area that is of most focus.
All right, well, let's pivot here because it is time for today's runway showdown. A soccer manager is going to face off against a pit lane strategy. Stage left, the manager's rotation, a balanced starting 11 lineup built for the full soccer season. Think broad, diversified core holdings that keep you on the catwalk through ups and downs. No single star carries the show. Consistency does. Stage right, the pit lane strategy on the racetrack. Fast time moves. This is your tactical overlay. Option income when the match slows, a short burst of leverage tech when you need acceleration. And the question for you, Will, is who's wearing the better strategy for current markets in mid-2025? Are you going to go with smooth minutes and fewer surprises, or do you target speed, trusting the pit crew, making sure to time those stops?
Dun, dun, dun.
I think it's got to be the speed strategy. I think we're in a market where
I thought you were an F1 man.
A bit more nimble, a bit more volatility. A lot of stuff can happen. There's still geopolitical surprises, other surprises that can move markets. I think when you're at the top of a market, it's also time to pay attention a little bit more.
What happens if you're an everyday investor who's maybe thinking, okay, in 5 years, I want to buy a house, or in 5 years, I have these big goals of mine. Would you still be that F1 driver?
I think if you're an everyday investor, and therefore you're implying that you don't probably either have the knowledge, the patience, or either want to be looking at markets all the time, then I think that's when you just have to start investing. And again, it's just all about time horizon at the end of the day. And by investing a little bit, every month or every quarter, you probably avoid some of the market timing issues that can worry people.
Yeah.
I like to talk about risk management here quite a bit. So just wondering what your thoughts are on how the everyday average investor should be thinking about how to use some of your products reasonably with reasonable risk management.
I think if we're talking about reasonable risk management, leaving aside tactical things, because tactical can get into, I think, some complex issues, I think gold should be a permanent piece of real estate in a diversified portfolio. So just a question of how much you want to allocate to gold, but a reasonable allocation, somewhere between 5 and 10%, maybe in gold. Some bonds, particularly more on the shorter end of the curve, also, traditionally held or should be held as a diversified portfolio. But beyond that, depending on your age, you probably should be trying to take a lot of risk because your time is on your side.
How much are we allocating to crypto these days?
I mean, crypto to me is still firmly in the risk on bucket. So again, that depends on your sort of risk tolerance to that. That's like
any crypto specific crypto ETFs. I know you got the Coinbase ones, but anything else in there?
I mean, I think not sort of anything specific other than outside of Coinbase. We have exposure to some of the miners, et cetera. So we have a lot of different individual stock exposures, but they're all popular in different ways. And it's just a question of, are you sort of all in on companies like Coinbase, or are you much more in the mining sort of side of things, or even some of the issuers of the stable coins, et cetera. So all different ways to play it.
Riskier there as part of your portfolio.
Oh, to me, the cryptocurrency is firmly a risk-on asset. Again, nothing wrong with it. It's just firmly in the risk-on bucket as opposed to something like gold, which to me is risk-off.
Well, guess what, everybody? We have wound things down here, but just a quick review. We learned about exchange-traded funds, how they're kind of imitating some of these old hedge fund strategies, allowing you to get income off of options, and also leverage, how to use it safely, how to understand these products, and finally, what the Fed is going to do as we see interest creeping up a little bit, and also as real yields come down and make gold and commodities more viable investments. So make sure you catch all the episodes of Stocks in Translation on the Yahoo Finance site or wherever you get your podcasts.